All right, welcome to The Explainer. So Bellring Brands just dropped their Q3 2025 earnings. And honestly, the numbers tell a really fascinating story. We're going to dig into the key takeaways from what their CFO, Paul Rode, had to say.
You know, after any earnings call, the big question on everyone's mind is pretty simple, right? Was it a good quarter? So let's just jump right into the headline numbers and see what they tell us. Okay, first things first, let's talk top-line revenue. The company pulled in a cool $548 million in net sales. Now, that's a solid 6% jump from this time last year, and it even nudged just a little bit ahead of what analysts were predicting. Definitely a strong start.
And what about profitability? Well, their adjusted EBITDA, which is a really great way to measure their core operating profit, it hit $120 million. And that was pretty much right on the money with expectations, giving them a very healthy 22% margin.
So to get the full story behind these big numbers, we're going to break it down into 5 key areas from the CFO's report. We'll kick things off with the Q3 scorecard, then peek inside their profit engine, check out their cash and debt situation, and finally, look at their guidance for the future and some of the challenges they see coming up.
All right, first up, the Q3 scorecard. Let's take a closer look at those sales figures because there's this really interesting kind of disconnect between what people actually bought in stores versus what the company shipped out to those stores.
And here's where it gets interesting. You can see the gap right here. The CFO pointed out that what consumers actually bought, we're talking shakes flying off the shelves, grew by an impressive 19%. But shipments to the stores, that only grew by 6%. Now, this gap wasn't a surprise. They were expecting it, and it's mostly because retailers were kind of playing with their inventory levels, plus some timing quirks with online promotions.
Okay, so we know consumer demand was red hot. But the big question is, how much money did they actually make from all those sales? For that, we've got to look inside the profit engine.
The adjusted gross margin landed at 35.1%. Now, that's actually down a bit, about 1.3 percentage points from last year. And the CFO laid out 3 main culprits for that squeeze. First, higher costs for their ingredients. Second, they spent more on promotions. And third, they're now being compared to a period last year where they had some unique one-time cost benefits that aren't there anymore.
Now let's talk about operating expenses because this is a wild one. The total number looks huge, $145 million. But here's the kicker. Nearly half of that was a one-time $68 million hit for a legal issue with an old brand they don't even sell anymore. So if you pull that out of the equation, their normal day-to-day expenses were actually a much more reasonable $76 million.
All right, let's switch gears and look at the company's overall financial health. We're talking cash, debt, and what they're doing with their money.
So, the company generated a solid $40 million in cash just from its operations. They kept their net leverage ratio, that's basically debt compared to earnings, at a very manageable 2 times. And what do they do with their cash? Well, they spent a whopping $83 million buying back their own stock. And as you know, that's usually a big sign that management is really confident in the future of the business. Okay, so that's the story for Q3. Now let's pivot and look ahead. What does the company think the rest of the year is going to look like? Well, they've actually tightened up their forecast for the full year, and the outlook is still really strong. We're talking double-digit growth across the board. They're projecting net sales to grow somewhere between 14 and 16%, and for adjusted EBITDA, they're looking at a 9 to 11% increase. Not bad at all. But it's not all sunshine and roses. The CFO was pretty upfront about some challenges that are definitely looming on the horizon, especially as they head into the fourth quarter and look toward next year.
Yeah, for this last quarter of the year, their profit margins are expected to get squeezed pretty hard from a few different directions. You've got higher spending on promotions, you've got increased costs for key ingredients like protein, and on top of all that, there are some leftover costs from a packaging redesign, plus they're up against that tough comparison to last year's one-time benefits. It's kind of a perfect storm of pressures.
And one of the biggest future costs they're keeping a close eye on? Tariffs. Just a quick refresher here. A tariff is basically a tax that gets slapped on imported goods. And for a company like Bellring, that can make their raw materials a whole lot more expensive. And this is the big one to watch. The CFO specifically called out a new 15% tariff that's going to hit key protein ingredients they get from places like New Zealand and the EU. Now, he said they're working hard to try and soften that blow, but they still think it's going to have a low single-digit impact on their total costs next year. That's a real headwind. But despite all these potential headwinds, the company's official stance is still one of confidence, and it's really summed up perfectly in this quote from the CFO himself.
So here's what it all boils down to, right? Bellring is absolutely crushing it when it comes to consumer growth. That's exactly what you want to see. But at the exact same time, they are staring down some very real cost pressures. We're talking inflation, promotions, and now these new tariffs. So the million-dollar question is, can their strategy and the power of their brand be enough to keep this winning streak alive? That is definitely what we'll be watching.